Hello, everyone. It's Tuesday, January 31st, last day of January. Today on the Final Bar, we will talk about this market pushing back to the upside. Yesterday, all about distribution. Yesterday, about the market giving back some of those previous gains. Today, taking it all back and more. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold and cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is designed to help you think about the lessons that are provided back from the market in the form of price and breadth and sentiment, momentum, trend, all of these ways that we can quantify investor behavior. Today, we're going to focus a little bit on breadth indicators. We've got some time allocated to a segment called Banking on Breadth, where we'll dig into something like the McClellan Oscillator, things like advanced decline lines, moving average breadth indicators, and all these different ways that we can measure the participation, right? The trend in the market, the price of the S&P shows you the value, right? Which is reflective of all the different buying and sell decisions that happen on a given day. But breadth indicators tell you more about the underneath the hood question, right? What are the companies that comprise those major indexes and what are they doing? So an analysis of breadth is an important part of my toolkit. We'll talk through some of the breadth charts recently, really showing strength out of the lows in October and continuing to push to the upside. We'll see as we update some of the closing data here today, because I would assume continues to push upwards after yesterday's pullback and today's recovery. A lot of charts to get to here in a minute. As we start our market recap, I did want to begin with a poll. We asked you recently, you struggle to sell a losing position basically because of an emotional connection to the position. Which behavioral bias are you demonstrating? We gave you four choices: confirmation bias, endowment bias, selling bias, or narrative bias. 62% of you, 100% correct, endowment bias. The endowment bias, or the endowment effect, is where you basically do something different. Instead of selling a losing position, instead of taking profits when it's so clear that you should, you continue to hold it as the position goes against you, as the market goes against your position. And it really is because of your emotional connection to that thing, right? And it's not just something that happens with your investments. Think of a coffee cup that is a special coffee cup from a special place that you went to, and you have an emotional connection to it that has value to you. But to me, who has never been to that place or seen that coffee cup, it's just a thing to hold my coffee. And so just like we develop emotional attachment to the things that we own, especially really special things, we have that a lot less or certainly that's one of the things you want to avoid when you're looking at your portfolio, right? You want to think of those positions as things you rent, not things you own, and not be afraid to exit positions that are no longer working. Confirmation bias, 24% of you said that one. That is a really sneaky one as well. And I would encourage you to read up and listen, think about confirmation bias, where you develop your thesis and then gather evidence. Make sure you focus on gathering the evidence first. Let's continue on now with our market recap. All right, so as we're looking at the two-day preview chart here on our dashboard, we can see yesterday's distribution day, right? So as we were talking on the show yesterday on Monday the 30th, we saw just sort of a slow and steady decline through the course of the day, particularly going into the closing bell as we were getting ready for the show. We saw just continued push to the downside. Now, again, these are stocks coming off fairly elevated levels. Pretty good run here so far in the early stages of 2023. But yesterday, very much a give back day as the market pushed lower. Today, we sort of opened down around those levels. We regained all the way back to yesterday's close and even a little bit more, particularly in the last 30 minutes, where you saw the major averages accelerate to the upside and just finishing stronger and stronger. A nice strong finish to the race here. The S&P 500 finishing the day up 1.5% at 4076. The NASDAQ composite up 1 2/3%. Small caps leading the way higher, up 2.5%. We'll see if we have time to look at some of the small cap indexes. Point of order, I think the S&P 500, one of the few indexes that's not already broken to a new swing high. All of the other ones that I just mentioned pretty much have. And you'll see what I mean here in a few minutes. VIX, the volatility gauge that we usually refer to, coming back a little bit. It was pushing up toward that 20 level, which is a key level we've talked about many times. Coming off a bit here, still above 19, around 1930. Looking at other asset classes, mixed results from the bond markets, although the TLT was stronger today, just under 1%. 10-year yields came off a bit, with the 10-year yield currently around 353 around the equity close. And the dollar index down about 0.25% using the UUP, that's a bullish dollar ETF. Commodities green across the board, gold up 1/3%, silver up about 0.75%. The commodity space as a whole, we use the DBC as a good proxy for that, up about 1.7%. So you're seeing some energy components doing okay. The energy sector actually lagging behind, and there's some interesting stocks that have not really broken out, while other areas of the market, more growth-oriented parts of the market, have certainly thrived here recently. Finally, cryptocurrencies green across the board. When we look at the 10 most liquid coins that we track, Bitcoin is back above 23,000. Ether nearing that 1,600 level. It was above 1,600 yesterday, but pulled back below today, sort of rotating back to the upside. So those charts, by the way, are pretty interesting setups here, and you're seeing something different, I would argue, right, in the last couple months, relative to the underlying trend or the overarching trend in 2022. 2022 certainly a distributive period for cryptocurrencies, coming off of all-time highs and giving back a lot of those gains, but you're starting to see something different, breaking to new swing highs, potentially putting in higher lows. And I think that's the question mark on charts like Bitcoin and Ether, is to see if they're able to hold up and follow through to the upside after those recent gains. Let's look at a chart of the S&P 500. We'll jump around a little bit. You know, here was Friday's pullback as we came back down toward 4,000. We stayed above it, though. And today, again, sort of rotating back to the upside, finishing more towards the close from Friday, right? So Friday closed around these levels, around 40.75. We now have a 2-day period where we've returned right back to that level. So this market continues to have down days where you give back some of the recent gains, and then soon after continues to push the upside. And that's really the characteristics of more of a bull market phase, right? You have those pullback days, which is normal in any environment, but then you continue to rotate higher, right? You see that buyers are coming in and buying on the short-term weakness and pushing the market a little bit to the upside. A lot of potential catalysts this week. We are in the meat of earnings season, I would say, today. You have Meta reporting after the close, along with a number of other names as well. Before the open, we had a number of things like T-Mobile, Peloton, and others. We'll see if we can get through some of those. 3 other FANG stocks reporting tomorrow: Amazon, Apple. Sorry, I'm looking at the wrong day. What am I doing? I was going to say that's not right. Sorry, today, EA, Electronic Arts, AMD, Semiconductors, Snap reporting, Amgen reporting today. Tomorrow we have Meta after the close, along with the Fed meeting, and then into Thursday as well. We have Amazon, Apple, and Alphabet. So what are we seeing with the S&P? Again, I tend to think of a chart like this as what is the most likely setup, or what is sort of the general phase we're in, but then what's the alternate hypothesis, right? What's sort of my main observation, and then what's the other thing that could be happening? And for the longest time, I've been thinking this market as bearish, but here are the bullish things I would need to see, right? And as we're making new lows in October, it's clearly bearish, I would say, in terms of the trend, but things you would need to see, you know, bullish momentum divergence, we need to see follow through. We did. Well, we've been putting in lower lows. We need to put in a pretty significant higher low. We did that at the end of December. Instead of remaining below this trend line resistance, instead of remaining below the 200-day, we'd have to push above those levels. We've done those things too. The last thing we've not done is get to a new swing high in a big way. And I think the November, December highs around 4,100. That's the level. So today, as we're rallying into the close, I'm immediately looking left on this chart and seeing, are we getting above that level yet? We're not quite there, but you're certainly seeing this momentum build into here. And we're setting up just magnificently for the Fed meeting this week, right? And the question is, do we hear enough from these earnings reports, which are in some mega cap names that have market moving potential, and comments with the Fed governors and Powell's press conference, to sort of get enough upside momentum to power through that 4,100 level? I think that's the question. And if we do, That's the most bullish thing most bullish evidence we can see. It's less about what the companies are saying. It's less about what we think about the Fed. It's whether the market tells us that there's renewed optimism and an influx of buying power coming into the market. I think only a break above 4,100 is what confirms that, really completes this list, this sort of bullish checklist off of the new low. After that, I'm out of things on my checklist of reasons why this wouldn't be a bull market phase and why we could top out at 4,150. It just tells me if we get above there, that tells me that there might be some staying power, and I would immediately be looking at the August high, just above 4,300 as a potential upside objective. Now, part of my morning coffee routine, I did a webcast on this last week, and we dug into my morning coffee routine. I literally walked through it from start to finish, and this is one of the pages we spent a little bit of time on, and this is what I look at. One of the things I look at every morning, and it's all the different U.S. equity market indexes. And I spend most of the time on this show talking about the S&P just for brevity, and because I think if you're going to follow one benchmark, that's certainly the U.S. benchmark I would be following. But what's great about this sort of candle glance view is you can see the S&P 500. Again, that's the on the little chart here, testing the swing high in early December around 4,100. We're kind of right there, right? We're very, very close. And if we would fail here, that would be a perfect double topping pattern that would make a ton of sense as well. But look at the New York Composite Index already making a new swing high. Look at the FANG Plus Index already above its December high. Look at the Russell 2000 already above its December high. The Mid Cap 400 Index, the Small Cap 600 Index, the Vanguard, the VXF ETF making a new swing high. The Microcap Index, the Wilshire 5000, the Value Line Arithmetic Index, the Value Line Geometric Index, all of those indexes that I just mentioned have already made a new swing high. So while the S&P is struggling to get above that peak in November and December, all the other indexes that I just mentioned, like everything else, is already making a new swing high. So when I think about the probability of the S&P making it above there, charts like this, combined with the breadth measures we'll talk about here in a few minutes, sort of line up in that idea that the strength is there. The strength in individual names, particularly outside of the mega cap space, are already there. When I see the micro cap index making new swing highs, when I see the small cap index making new swing highs already after breaking through moving average resistance, it certainly seems like there's underlying strength there. And in a lot of ways, the S&P may be the last chart to recognize the underlying strength in the equity space. Let's take a quick commercial break. We'll be back with our next segment, Banking on Breadth. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for your flexibility this week. We're doing this a little delayed yesterday and today around 6 p.m. We'll be back live at 4 p.m. Eastern tomorrow. We have the crews at the StockCharts TV studio here in Redmond making some finishing touches on the enhancements we're making to the studio. We'll be back in there testing it tomorrow, and hopefully very soon bringing the show to you live from our new studio. The rest of this week, pretty good week. We have on Wednesday, February 1st, Sam Stovall. On Thursday, February 2nd, Dave Landry of DaveLandry.com. This Friday the 3rd, and Monday the 6th, I will be out with my family in Cleveland, Ohio, visiting my parents and my brother and his family. And Julius DeKempener, founder of RRG Research and longtime StockCharts contributor, has very graciously agreed to come in and guest host for us. He'll most likely be doing a mailbag segment. Maybe we'll get him to talk a little bit about sector rotation using his RRG methodology, but he will be navigating the ship on Friday and Monday. I'll be back with you live on Tuesday, February 7th. Also, by the way, other things coming on. We have questions available at all times in our mailbag. Our mailbag is open as you are trying to navigate these markets. You can go to or send us an email at thefinalbar@stockcharts.com with all of your questions as you're analyzing your charts of interest. We're on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel, and we'll hope to answer your question in our next mailbag. StockChartsTV.com, that is our on-demand platform. So much great guest discussions, fantastic contributor commentaries, all available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on our show today with our next segment, Banking on Breadth. What we want to do is just check in on some of the breadth indicators that we follow. I mentioned earlier before the break my morning coffee routine, which is sort of the process I normally go through every morning to try to gather information and make sense of what's happening around me. And this is one of the chart lists that I review every morning. I don't go through every one of these charts exhaustively, but I certainly pay attention to them and look through them consistently. I want to highlight a couple of these that I think are worth paying attention to, and we'll see how many of these we can get to. We'll start with the S&P 500 and the breadth by cap tiers. This chart is so interesting right now because the S&P, as I mentioned, so far not quite making it above its November peak, right? The peak from the end of November. That was the last significant swing high. So you take a step back and look at the swing highs and lows. A bull market phase has higher highs and higher lows. A bear market phase has lower lows and lower highs. So as I see the lower lows going into the end of last year, and all of a sudden I see a big higher low right before the new year, I start to think, all right, maybe this is the beginning of a much more bullish rotation. To complete that, you need to break to the new swing high, which would be a close above that high from the end of, or that close from the end of November. We've not quite done it yet. Now, as I mentioned in our market recap, you're seeing that in other indexes, things like mid caps, small caps, micro caps, many other indexes covering the U.S. markets and certainly some non-U.S. markets as well. What's interesting is if you look at the advanced decline lines in different areas of the U.S. market. So we have the New York Stock Exchange, which is a pretty broad and diverse list of stocks. We have large caps, mid caps, and small caps. All four of these are already well above their November high. So while the S&P is not quite there yet, you can see that all these other cap tiers are. Now, how is that possible that the index cannot be making a new high and these breadth indicators can? Well, it comes down to how our indexes are constructed and what these different things are measured, right? So the S&P 500 is a cap-weighted group of 500 stocks. And that phrase cap-weighted is very important because that means the biggest names, the Amazons, the Apples, the Alphabets, the Microsofts, make up a lion's share of the index, and it depends on when you look, but usually the top 10 to 20 stocks in the S&P are about the same weight as the bottom 300. That's how much those big top-heavy names influence the S&P 500. So when the mega cap FANG stocks are not leading, you can have this situation where the advanced decline lines actually look pretty bullish, but the major averages are not quite there yet because they are focused way more on the mega cap names. These advanced decline lines are all equal weighted, which means Apple has the same weight as any other name in the S&P 500, right? Even the smallest mid cap name out of those 500 stocks has the exact same importance as the mega cap names. As a result, when it's more mid and small cap stocks that are outperforming, which is something we've seen here out of the October low, these advanced decline lines and other equal weighted breadth measures will tend to look a lot better. And usually that's a great measure of underlying strength in the equity market. So encouraging sign, these are all color coded subjectively, and I have them all as bullish green because they're all continuing to make higher highs and higher lows. That's a constructive pattern that we've seen. We talk about this chart pretty regularly. This is part of my Mindful Investor Live chart list. These are the percent of stocks making it above their 50 and 200-day moving averages at any given time. With the rally today, we're over 70% in both of these readings, which means over 7 out of 10 S&P names are above their 200-day moving average. Almost 3 out of 4 S&P 500 names are above their 50-day moving average. Those are bullish numbers. And generally speaking, back of the envelope, when these readings are above 50%, that's generally bullish. When they're below 50%, that's generally bearish. And you can see for how 2022, we saw a big shift from these indexes being consistently above 50% to consistently below. And that showed you how many stocks were breaking down through those key long-term measures of trend performance and trend analysis. So now that they're making new swing highs, and now we're seeing 7 out of 10 stocks above their 200-day, this is a broad advance and a healthy advance, right? The market pulls back and these indicators get below 50%. That would be the bearish sign. We're certainly not seeing that anytime recently. I want to briefly bring up the Bullish Percent Indexes. These are indexes, breadth indicators derived from point and figure charts. So what this is doing is looking at 500 point and figure charts, essentially one by one. We're doing it systematically, but imagine that you are analyzing 500 point and figure charts and making the assessment, is this bullish or bearish? We have an algorithm that does that work for you, but what it's basically doing is saying what percent of the S&P 500 charts are in a bullish point and figure mode right at the moment. It's currently just below 70%. Now, I've highlighted over the last 8 months or so, when we have gotten above 70%, that has been a sign of market strength, but it's also been toward the later stages of that rally. So we got above the 70% line at the end of March of last year, end of July of last year, and beginning of November. And each one of those times, it was about 1 to 3 weeks before the end of that rally phase, before we had a pretty decent drawdown in every one of those cases. So if we do power above 70%, which it's appearing more and more likely that we do, I'm immediately bringing up this chart and looking to see when we would come out of that range. Now, that doesn't mean we can't go above there and stay above there for quite some time. That's what you've seen in a couple of these observations. So getting above 70% is not a sell signal. Coming back out of that 70% level is an important thing to maybe watch for. You can do the same thing on a bunch of different universes of stocks. And on the StockCharts platform, we have the S&P 500, the NASDAQ 100, a bunch of other things, sector indexes. We have programmed with their Bullish Percent Indexes as well. The NASDAQ 100, similar thing, right? You look to see if when it gets above 70%, look to see when it comes out back below that 70% level. I've highlighted with these red shaded areas every time when that's happened, when we've gone above 70% and come back below. And you can see those have been some significant peaks over the last 8 or 9 months. So as we continue to show strength, I'm immediately drawn to these breadth indicators that often suggest an exhaustion point in that rally. We're not to that valley or not to that initiation yet, but we'll certainly something to look for here going forward. Next, I want to talk briefly about the McClellan Oscillator. Sherman and Marion McClellan, Tom McClellan's parents were the ones that designed this indicator. Sherman McClellan is a fascinating man who I've gotten to meet and talk to many, many times with his involvement in the CMT Association and also here on the West Coast. And it's been a pleasure to get to know him a little bit. What a great sort of thinker about market conditions and market breadth. And it's so cool that that Tom McClellan continues that work through his work with the McClellan Market Report. The McClellan Oscillator is a derivation of that advanced decline data that I showed earlier. It uses exponential moving averages to smooth out those readings a little bit. Generally speaking, the McClellan Oscillator above zero, those are bullish conditions. The McClellan Oscillator below the zero line, and the trend is slowing down, and we start to show signs of distribution. You can see recently, right over the last 8 months or so, this is the last year, I'm looking back 12 months. You can see when the McClellan Oscillator goes above zero, like we did most recently back here in October. And then you can see we often spend some time above there. And we finally broke back below it. That tells you that often that uptrend phase is over. And while it might not be the worst downtrend ever, it basically tells you that there's at least a pause in that uptrend at best. I mean, and even more possibly there's a deeper drawdown and time before last was here in September when we went into the September and October lows. So as we have rotated back very high above the zero level and now coming back down, this is telling you that while the conditions are still bullish, if we would break below the zero level, that would be a red flag of sorts, telling you that we might be at the end of this bullish phase and potentially coming back. Now, this isn't updated yet for today's close. Most likely, the McClellan Oscillator turns back higher when we process the data here after the closing bell. But that's something I would be looking for. You can take that data and aggregate it over time and turn it into what's called the McClellan Summation Index. Same idea. This is trending upwards. We're in an uptrend. This is trending downwards. We're starting to slow down a little bit. This would slope downwards if the McClellan Oscillator gets below zero. So they're kind of connected in that way. But that's what I would be looking for here at this point. These indicators are still very constructive in telling you that there's underlying strength in the market. And anytime there's underlying strength, I would look at this breadth list to find signs that that upward strength is starting to alleviate. We're not quite seeing that yet. I did want to mention the new highs and new lows, because what I've often said is a bull market is usually marked by an expansion in new highs, a bear market often marked by an expansion in new lows. And this is using new 52-week lows on the New York Stock Exchange, on the S&P 500, and on the NASDAQ. And I like using this histogram as a way to illustrate those new highs and new lows, because a lot of times you can have a lot of both. And actually, some indicators like the Hindenburg Omen are actually driven off of having an increasing number of both new highs and new lows, which often can represent indecision. Now, it looks like there's not a lot of green here. And if you look back over time, that may be a fair assessment, but there have been such significant downdrafts with a lot of new lows that it's kind of skewing the chart here. If we look at just the last 3 months, which kind of gets rid of that really negative data, you can actually see there's a decent number of new highs. Now, it's not a ton, right? So in the last couple of days, you've had 10 to 20 S&P names making a new 52-week high. That's out of 500 stocks. That's not a huge number. That's like 2 to 4%. That's not huge. And I would say if you are bullish and if you believe in the upside potential for stocks, I would be looking for more and more green on this chart. We're not quite seeing that yet. We're not seeing a lot of new lows, meaning not a lot of stocks are breaking down here, but we're not really seeing stocks recover all the way to their 52-week high. It tells you there's still more to be proven, maybe, to really have a full-fledged, sort of long and strong bullish phase. But starting to see signs of optimism in some of these breadth indicators. That's our segment, Banking on Breadth. We got to wrap the show. Let's go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. In our segment, Banking on Breadth, we talked about the McClellan Oscillator. The McClellan Oscillator I've used for a number of years, back to my early introduction to technical analysis when I was at Bloomberg in New York. We feature the McClellan Oscillator on our platform there, and I'm so glad that I've been able to follow it over time. This is just one of those classic breadth indicators that I like to know where it is. And very, generally speaking, if I had a breadth dashboard, the McClellan Oscillator and just its value would certainly be on there. Is it above or below zero? And that would be a great sort of simple thumbs up or thumbs down. If it's above zero, the conditions are positive. If it's below zero, the conditions are negative. Again, that is a gross generalization, but I think generally speaking, a pretty decent one, a good shorthand for the overall breadth conditions in the market. At this point, the McClellan Oscillator is still positive, but when you've had a market that's had a good run, which we certainly have, I would argue that you look for these indicators to see when they turn negative, because at this point, following the market higher is totally fair, but look for signs of deterioration in these breadth indicators. We have not seen them yet. Chart number 2 is Ethereum. I had a really good conversation and a shout out to my friend Adrian Zrunchik. Adrian is a crypto bird, founder of the Burb Nest. And so any of you that follow Adrian and his work, what a fantastic, super nice guy. And we talked a little bit about cryptocurrencies along with technical analysis, the CMT, and a lot of other really cool stuff. It led me to think a little bit more about cryptocurrencies today. I was looking at the chart of Bitcoin, at Ether, and some others, and Bitcoin, I think, has really broken out. And now the question is, do we see follow through? I think with the chart of Ether, it's a really fascinating point because you had this peak in early November when it tested the 200-day. We now broke through the 200-day. Pretty encouraging. The 200-day is now sloping upwards. Pretty encouraging as well. Now we're waiting for that final breakthrough. So just like the S&P, can it get above 4,100, get above that level of resistance? I think the same thing for Ethereum. And how bullish does this chart look if we get above a 1,700 level? That clears the way, I think, very easily to 2,000. Big round number, which often tends to be important. Finally, Adobe, ADBE. This is one of my phenomena stocks, sort of the FANG and FANG-like names. I just want to highlight, when I talk about how the conditions have turned more bullish, this is the kind of chart that stands out in my head. Take a trend line over the last 12 months, and you can see connecting the November 21 peak, the August 22 peak, lines up with where we broke out here in the month of January of 23. That's encouraging. We went from being below the 200-day moving average since December of 21 to breaking back above the 200-day moving average in the last week. That's bullish as well. We had the rally off the September low, but then we consolidated in this sort of 320 to 350 range. We've now broken out of that. So charts like this are breaking from a bearish phase of new lows and higher, lower highs and lower lows to reverting that. And the momentum conditions are improving as well. The more charts like Adobe that I see, the more constructive I feel that the evidence is in. But as always, be wary and let's make sure we hold support on any sort of pullbacks, which are certainly likely and possible at any given point. Folks, that's a wrap for today. I want to thank you so much for joining us here on the Final Bar every weekday after the close. Thanks for being patient this week as we work on our studio and show the show a little bit later. We'll be back live at 4 p.m. Eastern here on Wednesday, February 1st. Congrats on making it through the first month of the year. We'll continue on through the course of the rest of 2023. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.